Hello everyone. Today I want to discuss about basics of a stock market, and we will be learning about the stock market from scratch. Let's move further and see what we have in our stocks. In this tutorial or lecture video, you can say, we will be discussing few things. We will be discussing about what exactly is the stock market, and we will be taking a real life example to understand its analogy with the stock market. We will be knowing about BSE and NSE, what exactly are they. We will be knowing about Sensex, Nifty, and what has been their performance in previous years. We will be discussing the annualized return of Nifty. If you have invested in say Nifty, what gains you would have made based on that. Now, at last, we will be discussing why people are afraid of it and less people earn profit from it. Now, this is a very important factor in investing money. So, let's move forward. Here we can see here a person is trying to sell all his different kinds of vegetables to different vendors. And now here a person is buying from them. Let's name this person as Baburao, and let's name this person as Shyam. Now here, as we can see, whatever material Baburao has picked up from the market, he is trying, suppose he has bought these material at a cost of, let's say, 100 rupees. Now he is trying to sell these materials, or you can say these vegetables and fruits, to Shyam, and he definitely would need to earn profit so that he can earn a living. Suppose he want to sell all of his vegetables and fruits at a cost of, say, rupees 110. Now Shyam agrees to pay 110 rupees because he found that if he would have tried procuring these items, he may have incurred more amount or energy. So he found that 110 is optimum amount, and I should buy these fruits and vegetables at this cost. In this process, Baburao is earning a profit of 10%. Generally, a businessman do not try to earn 10%. He tries for more and more profit. Sometimes that profit may also go to 100%. However, it all depends on what are Baburao's marketing skills and how he can convince Shyam to buy whatever fruits and vegetables are there at an higher cost so that he can earn more and more profit. Here, Shyam's intention is to buy all these fruits and vegetables at a lower cost so that he pays less amount from his pocket and get whatever he needs at lesser amount. So what do we see in here? Here we see a system of market where one person buys and he tries to buy at a lower price, and one person sells and he tries to sell at a higher price. The stock market buying and selling happens in a similar way. So let's see what this price comes from and how are these prices manipulated in the market. These are the golden rules of economics or market, that is supply and demand. As soon as the demand falls, let's suppose Shyam do not want to buy Shyam do not want to buy any kind of vegetable because he is happy not eating vegetables. And the supply of vegetable in the market is rising exponentially. This may be due to any reason. Let's suppose the product in this season was too much. Baburao has stored all his products, but now he is seeing that his products are being damaged. So he is trying to sell all his products so that he can earn slight profit or whatever margin of amount he can get. In this manner, whenever this supply is being raised and whenever the demand falls, even if one of them happens, the price is definitely going to fall. On the contrary, if the demand is rising, suppose Shyam is advised by doctor to eat more and more fruits and vegetables, and he instantly goes to market to buy those fruits and vegetables. At the same time, suddenly everyone hears that the amount of vegetable and food is going to vanish, or you can say the food supply in this season was not so good. That's why they are trying to buy at whatever rate they have. I mean, here I am referring to the customers who do not have access to farms, and they are ready to buy all the fruits and vegetables at whatever rate they want. So here the prices will rise at a very high rate, and even if the cost of fruits and vegetables was 100, it may even goes to 200, 300. It all depends on how much demand or supply is, how much demand rises there or supply fall is there. In a similar manner, the reverse happens for this case. After understanding these two parts, we only have to implement this analogy in the stock market. How do we do that? So let's go further. Here we have certain companies. These are the small cap companies. Here we have the mid cap companies. Here we have the large cap companies. We do not have to go into the technical details of these things. We just have to know that small cap companies have a market capitalization of, say, less than 5 crore. It is actually 5,000 crore for Indian market. For mid cap companies, it is 5,000 crore to 20,000 crore. And for large cap companies, it is more than 20,000 crore. However, these definitions are based on market and it may change at different points of time. Now, every company needs certain money to have to run its business. Suppose this Mirch Tech, Parab Infra and Kuber Udyog, they all have, say, 1,000 rupees. Now, to run their business, maybe this 1,000 rupees is not enough. So, they will go and invite some persons to invest another 1,000 rupees in their company, and based on their investment, they will have a contract that if they earn a profit of 100 rupees, they will share 50 rupees with them and they will have only 50 rupees left for the company. Here, this 100 rupees taken from customers or any other people who invest in this company based on this contract, this 1,000 rupees is called equity money. This 1,000 rupees which the company already have with them, to do the business is called debt money. Here we are more concerned with this equity money. Here, if the company is in need of more equity money, it will go on to sell part of its stake of company to have that money and to run its business in more profitable way. However, by having only 1000 rupees, there may be chances that company may not sustain. Company may need certain money for giving salary to its employees. It may need money to give rent. It may need money to have good production. However, with a meager amount of 1000 rupees, it may not be able to handle all these things. So, whenever company is taking money from other investors, it is giving part of its stake to those investors where they sign a contract and reach on a conclusion that this much amount of profit will be shared between us. In a similar fashion, these large companies also have to get money to do the business. In a similar way, these are the mid-cap companies, these are the large-cap companies which need money to have the business. Here in this example, we have 1952 shareholders in this mid-tech company, and this 20,698 shareholders in this Parab Infra company. So these many people believe in the business of Parab Infra and they have invested their money in there. As we can see in the large cap companies, the number of investors are very large. They are 8,86,000 investors invested in this TCS. So these many people believe that TCS has got a business model which is going to give them a very good return. Now, where comes the stock market? When these persons do contract with this company by giving them money, they have only papers with them. They do not have real money. They have contract paper and the real money they have given to these companies to do the business. However, if a person, say Shyam, now he is having this contract paper and suppose the value of this contract paper is 100 rupees and Shyam instantly needs to buy all the fruits and vegetables which the doctor had advised him. But he is having only 100 rupees contract with him and no real money. So what will he do? He will try to sell this contract paper to, let's say, Ram, and he will say that please give me 100 rupees physical real money so that I can buy those fruits and vegetables and have this contract paper where you will have the same say as I am having in the company in which I have invested my money. Suppose Shyam thinks that this contract paper, which is having the value of only 100 rupees, will rise in future to 200 rupees. Ram also knows that the company performance and company business model is very much sustaining. It can earn him a good profit. But he also knows that Shyam is in need of money. So they will trade and settle at an amount which Shyam is ready to get and Ram is ready to pay. As I have told, the demand and supply rule, At whatever point they will settle, suppose they settle at 150 rupees. Now Ram will give 150 rupees to Shyam and take this contract paper with him. What will Shyam do? He will take the physical money of 150 rupees. He will buy fruits and vegetables of 100 rupees or 110 rupees as had been arranged by the shopkeeper, and he will earn a profit of 40 rupees just by investing 100 rupees. What Ram is getting? Ram has given 150 rupees to Shyam to get this contract paper, and in return, when the value of the contract reaches 200, he will sell this contract paper to another person and will earn 50 rupees profit on it. So the whole process of selling and buying contracts is called stock market, and this contract is called stock of a company when you are investing in them. Let's move further. Here we have a picture of BSE. This is Bombay Stock Exchange. Companies which are in need of money to run their business, they go to Bombay Stock Exchange and try to list their companies. That is, they try to register their companies in this stock exchange where their contract paper can be traded and they can earn money from it. Actually, at the first time when they register in this Bombay Stock Exchange, that first time registering is done based on IPO. This is called initial public offering. When this initial public offering is done, company releases some of its stake, say 1000 crore or say 1000 rupees for the sake of simplicity. Now, when it releases its stake of 1000 rupees, it is giving a contract paper of 1000 rupees to the customers who will give this company money to do whatever business they want to do. This contract value, this contract will be given to the customers and they will get the stock of that company by paying the amount to them. Afterwards, it will be registered in this exchange, and here other customers, say customer 1 who didn't get this contract paper in the initial public offering, will try to buy this contract paper from customer 2 in higher or lower price based on the performance of company. I hope this would have made you clear that what exactly is the operation of the stock market. Actually, it is a secondary market where the trade of securities, secondary market where the trade of securities happen of different lists. You would be seeing certain lists on the left and right. These are a group of companies in BSE which is termed, and this group of companies is given an index term named Sensex. In this Sensex, these 30 companies are combined, and whatever their combined rise or fall is there is registered in the value of Sensex. The Sensex was first registered in 1979 at a value of 100 rupees. It is not 100 rupees, it is just 100 unit. So if the combined value of Sensex rise to 200, we can say that market as a whole has risen by 100%. Hence, right now the Sensex value is hovering around 45 to 46,000. You can say it has come a long way from 100 to 45 to 46,000. So whosoever would have invested 100 in 1979 or 1980, they would have made a stellar return of 450 times in 40 years. If you divide these things, you can say that the person is almost getting money increased 10 times every year for a straight 40 years. Now, when we knew of this Sensex and BSE, let's go further. Here, whatever we have discussed is depicted on a chart. On x-axis, we have year as 1981, 1983, 86. So these years are being rising from one to another. This chart has been taken from tradingeconomics.com, and the value of Sensex on y-axis is rising from 2000, and it has risen to 45,000. So this rise is the gain a person would have made had he invested in Sensex. As you can see, this year around 2007-2008, where the financial crisis occurred, the value of Sensex dropped from 20,000 to less than 10,000. A person who would have invested in these range would have taken loss, and it may have shattered whatever image they have for the stock market. These kind of occurrences or time really shakes people confidence, and these things may lead to stay away from the stock market. I will be discussing all these things in greater detail in further classes. Let's see about NSE now. The Nifty index was formed from 1996. Now, in Nifty, there are 50 companies. As I have told, in Sensex, there are group of 30 companies. In Nifty, there are group of 50 companies. So, their combined rise and fall defines the value of market based on whatever 50 companies are here. As you can see, then Sensex also and in Nifty also, there are different kinds of company. It's not that you only have pharmaceutical or consumer foods companies or finance companies. You have all different kinds of companies like paints, transport, infrastructure, IT services, gas distribution, automobiles. So these different kinds of companies covers a holistic, you can say, view of the total market of India. So whatever the index value is there, it somehow depicts the market sentiment, or you can say market value. There may be chances that the other indicators of economy may be going other way around, but these do have their impact and say in the current situations of market. Moving further, this is the chart of Nifty. As you can see, on a long run, it again has given a good return to its investors. In 1996, the Nifty started its journey from 100 points, and in just a span of 24 years it has risen to more than 13,000 per annum. Now this return is unimaginable when you get a return of 5 to 6% in FD, when you get in government schemes the return of 7 to 8% at max. However, they have certain security that you will be paid this much amount with a return, and that somehow gains the confidence of the normal consumers or normal customers, and hence many of them stay away from this stock market fearing that they will lose their money. However, this is not such a case. If we really try to understand the market, if we really find a way where we can see that how we can exploit the market situation and earn our profit, then this can help us in a lot of good way. Moving further, here we have performance of Nifty over the years from 1996 to 2020, and as I am posting this video in December 2020, so I have taken the last value as 1st December 2020. So these are the closing value, or you can say the opening value on 1st January 96, which I have noted down in different years. Now let's see if you would have invested taking 1 year horizon in mind and calculating your returns based on the 1 year period. As you can see, in this 24 years you would have encountered 7 years where you would have got losses. What are these 7 years? In the first year itself you would have earned a loss of 0.14%. In the after third year in 1999, I mean if you had invested on 1st January 98, after 1 year you would have occurred a loss of 18%. Again in 2001 you would have got a loss of 14%. In 2002 you would have got a loss of 16%. Now these things really shakes confidence of persons who invest in stock market, and after getting losses they run away from the market and do not want to know what are the intricacies and what are the problems, or you can say what are the details are there in stock market which they can exploit and earn more money. As you can see, after this 2002 the market has given very good returns till 2008 when the global financial crisis occurred. From that period the return was 71%, 9%, 37%, 40%, 50%. Now these return, if you would calculate on paper, you may have made your money, you can say 4 to 5 times in just a span of 5 years. This is impossible in any kind of FD or other government securities. However, after the fall of the financial crisis, the market wiped out and it fell by 51%. Now this is the point where we need to understand that when we have to invest and when we do not have to invest. We will be discussing all these things in our later classes. However, if you move the time frame to 3 years, like if you would have invested for a time period of 3 years, your losses would have reduced by 4 times. You would have you would have got losses only 3 times in this 22 years by taking a time horizon of 3 years on 22 times, you can say. So taking these 3 years as -1%, -8%, -0.2%, and all the aspects, you would have gained some money and you would not have got any kind of loss. Similarly, if you would have increased the time frame to 5 years, your loss would only be in 1 year, that is in 2013. This can be understood from the factor that before this 5 years, that is in 2008, the global financial crisis occurred, and because of the investment made in 2008, it would have taken a long time to crawl back from that position and earn a decent profit after 2013. However, if you again take the time period of 8 years, you can see in no years you are having any kind of losses. That means if you would have invested money in Nifty, keeping a time horizon of 8 years or more, there is no chance of losing money. Now, this is something which helps in gaining confidence when you invest in the stock market. As you can see, increasing the number of years, the return are spectacular, and if you would have invested for the time horizon of 20 years in 1996, you can see you would have gained around 40% per year, you can say. I have not calculated these results based on inflation. Inflation has to be adjusted in these things. But as you can see, the returns are phenomenal. These returns you will not be able to get in any kind of other instruments. So, this is the suggestions from my side, that try to study the market, try to know what are the intricacies and what are the problems in the market and how you can exploit those things to earn profit. Moving further, now this is an important part. Why do people fail and why do people lose money from stock market? The first thing is that the pain from loss, that is losing money, is too much and very high than pleasure from gaining. Suppose you have 1000 rupees, you invested in the stock market and gained 100 rupees. Now you would have gained 100 rupees and your actual amount would be 1100. However, if you lose this 100 money, your amount would be reduced to 900, and emotionally this 100 rupee loss will hurt you a lot, and you will not be able to rise from this loss if you are not emotionally strong. That is to say, when anticipating outcomes, the pain associated with losing weighs more heavily on us than potential pleasure of winning. This is one important thing. The second thing is, the stock market is not dangerous. It is the lack of knowledge which is dangerous. Once we try to understand what are the financial things in the stock market, how the company works, what is the business of company, how it earns profit, and what business do you understand? This is very important thing in investing your money, which we will be dealing in further classes. The next thing is risk management. If I go back and see the global financial crisis, let's see here in 2007 and 2008 is starting. At this point of time, suppose a person has lost 5% of money. Now, after losing 5% of money, as I said, that fear of losing creates more emotional impact on person. So he stayed invested and thought that still his money would recover and it may give him return of 10% or 20%, whatever. But if you take out your money from this point of time, then you could have saved yourself maybe a loss of 50%. That is 45% reduction in capital you would have saved if you would have stopped at 5% loss and exited at this point of time. This exit is very important, and after knowing the details of a stock market and understanding the market only, you would be able to make a correct decision of exiting the stock market. You can get this opportunity of investing again multiple times, but after really seeing and really understanding that what exactly is happening and how are the government helping in reviving the economy, or how are the people expecting the market to rise. These sentiments you will get only after reading news on a daily basis. So after this point of time, if you would have not invested at this point also, and if you would have invested at this point seeing that it has made certain pattern after which you can invest, this also would have given you a good gain and saved you from a big loss. Now moving further, so the risk management is very much important. The next important thing is impatience. A person who has invested money of 100 rupees in a stock market, if he thinks that in 1 month of time he can make this money as 200 rupees, in 2 months of time this money will grow to 400 rupees, then that person do not understand the stock market. That person do not simply understand business. If you are growing a sapling and providing water to it every day, it will grow with its own pace. You cannot force it to grow in just a matter of seconds or minutes. A person who becomes adult will become an adult in 20 years. You cannot expect him to become an adult in 5 or 10 years. So the market or business will take its own time to grow, and you should be impatient. You should not be impatient with this thing, and you should learn how you have to remain invested and get more profit. However, you should also be learning in a side-by-side manner the value of risk management, so that you do not fall for the more alluring things which can give you losses, which will be hurtful and which will be more painful than gain. That's it from my side. Thank you very much. If you have any suggestion or feedback, kindly give your suggestions. I will be telling you more about the companies and what the what are the opportunities of investing in those companies in my further videos. Thank you very much.